The next panel is Credit 101. So please join me in welcoming on stage Lizzie Chapman, the CEO and co-founder of Zest Money, Anurag Sinha, co-founder of OneCard, Karan Mehta, co-founder and CTO of Kissht, Akshay Mehrotra, co-founder and CEO of EarlySalary, and moderated by Ayush Bansal, the Senior Director of Strategy for Razorpay. Give them a round of applause and welcome them on this virtual stage. Hey Ayush.
Hi Karan. Hey.
Hey guys. All right. I'll just back away quickly and then you guys can start.
Thank you. We're waiting for Lizzie to come. Okay. Yeah, we have a panel here. Hi everyone. Hi everyone. Hi panelists. Hi audience. Thank you all for joining us today on this Friday afternoon. I'm super excited to host this panel today, and we'll be discussing some of the recent trends around credit industry and how the credit ecosystem is shaping up for the next few years. If I'm sure many of you would be following the session since morning, and one of the common theme or the flavor of the day which appears to be is credit and buy now pay later. I'm sure the panelists would be able to add more context to it and more use cases definitely. We'll begin with one of the most popular topic of this year. But before that, if you remind the team back, we talk about the major disruption which has happened in fintech industry, be it demonetization, the bounce back from demonetization, then ILF has happened, then yes, bank moratorium happened, and now COVID. Every time this has happened, there has been some skepticism of how the market is going to bounce back. We want to hear from the panel first in terms of what has been the recovery like. We have Lizzie on the panel, the founder of Zest. Zest Money helps consumers to do shopping using EMI without using a credit card. Lizzie, now that we are 3 quarters into the COVID world now, what has been recovery looking like for Zest Money so far?
Yeah, not surprisingly, it's been pretty good for us. I think you've already given a clue there. Buy now, pay later is the buzzword, but it's more than a buzzword. It's actually a movement that's happening around the world, and COVID has accelerated that dramatically. We've seen a massive resurgence in the last 3 or 4 months with a huge amount of organic demand for what we do, both from merchants, retailers, manufacturers, and most importantly from consumers who are sick of the old way of paying for things, which is credit cards. I hope we can have a bit of a debate about that today. But yeah, it's been incredible. Obviously, we have to be really careful. It's also a really difficult time. So for people like us, it's a really frustrating period of time because there's so much opportunity, so much demand, but there's still a great deal of uncertainty in the economy. And the last thing we want to do is overburden our consumers, especially because so many of them are using our products as their first credit instrument, right? So it's really important that we give them a safe and responsible experience. But yeah, it's been pretty good. We can go into some of the categories as well if you're interested. We've seen things like travel have come back in the last 60 days. We've seen electric bikes has exploded in the last 4 months, and EdTech has been booming since, the pandemic was first announced. So happy to go into any detail there as well.
No, I think that's really helpful. We'll touch upon those topics definitely, and I could see Anurag smiling when he spoke about the credit card, and we'll touch upon that topic definitely later part in the conversation. Akshay, EarlySalary works more on instant loans and the salary advances. So for your customer base, do you resonate with Lizzie's thought of the recovery coming back, but there's still some uncertainty? Or do you feel that this definitely we are into the growth period now, and then growth is also slightly sustainable?
I think let's look at the consumer category. Right? We are focused at salaried segment. Interestingly, I think we all panicked when COVID started. We all felt that there will be a large amount of delinquency mounting out, too many people opting for moratorium. I think our numbers actually came in much better. We only had less than 15% people wanting to go into moratorium, 85% people coming out of it without any worry within the first 2 cycles. which meant that we could go back to clear business focus. And if I look at November numbers, in organic terms, we got the same traffic as what we got in March. So we're actually back on track. We're already looking at December to say, can we do similar numbers as Feb or March as a company of disbursement? So business is back. I would agree with Lizzie on the other component that there are new categories that we all need to focus on. I think EdTech is one that we have seen large inroads. We launched EdTech as a channel within COVID. Now we have 100 partners that we service. And we really believe that consumers will like to now buy products on EMI. And I think we're seeing a huge uptake coming in there. We also launched our version of a digital card, and amazing numbers. First month, 3,500 people taking the card. So it's just a huge run rate that we are seeing. And our job is to make sure, can we come back to the same velocity? We were used to doing 70,000 loans a month. I think we're almost there. Another month or two, we should be back on the high-speed velocity game.
Awesome. That's very encouraging to hear that. Like, I think numbers hitting back February, March numbers are almost there. That's very, very encouraging signs for the industry at least. Another quick thoughts from you. So both Lizzie and Akshay spoke about the new segments opening up as a demand. So how do you see demand coming back like post-COVID, especially for your customers?
So clearly, as your credit card is largely focused on salaried segment, so a lot of things what Akshay spoke about, we are seeing in credit card.
Anurag, are you there with us? Okay. Okay, we'll take some.
Initially, we all thought that the losses will be much higher. Collection efficiencies have, improved all across, and most importantly, the demand for credit card is Incidentally, last month we also saw are almost back to pre-COVID numbers. So YOY growth of 5 to 7%. So this is good, and we are also seeing all across, growth happening in categories like fuel is almost back to normal. We still see restaurants and travel as two categories which are still behind, but the drop in that has been mostly picked up by other categories. Also, we are seeing that, just to echo what Lizzie was saying, that travel has really changed in the last 60 days. It was almost zero, and we are, I was just looking at the November number in, visa number, almost 50% recovery has happened as for the value wise. This is week on week, year on year comparison. So similar week in the last year. And similarly, restaurants are coming back in a big way. But these two categories still way behind. We've seen a lot of new categories coming up like home improvement, electronics, especially even groceries ticket sizes have gone up. So people are shifting their, buying patterns to, digital payment needs and all that. So all across, I think I would say numbers are much better compared to somebody would have asked me 4 months back. It's surprising for us. We're watching. Hopefully, January will get us much more insights about how much is sustainable. Because this will be the first quarter post moratorium where we will actually see the numbers appearing into financial statements of all lenders. But qualitatively speaking as well, almost everybody is back in the market, and I think the most of the conversation is around how do we capture the growth which we are all seeing in front of us over the next 3 to 4 quarters.
Awesome. We can definitely resonate those thoughts from Razorpay's data that we are seeing, that airlines and restaurants are also surprising us, that the recovery which we are seeing there. But hoping that all this is good trends and these are positive trends that we are seeing. Can I also request the panel to go on mute in case there is some echo? I think I'm getting some feedback, but thank you. So Karan, quickly taking thoughts from you as well. Kissht also works on a similar model as ZestMoney, like shopping on EMI without a credit card. Has there been any changes in the operating model because of pandemic? Like, did you have to tap into new data sources or have to revamp the models or policies? Like, what has been the impact on the policy side because of COVID?
No, that's interesting you brought that up, Ayush, because it's been a massive change. In fact, if I take the year from Feb until right now, we've literally come to a roller coaster ride. very early on in the pandemic, we had to take this decision on whether to clamp down on business or not. Then there was a question on when do you ramp business back up, whether there is demand or not. Lot of learnings. On the model perspective, operating model perspective, two big learnings. One is we have effectively discovered that we don't need office spaces. Apart from the call center, we are all really evaluating whether to even extend our leases. Everything except the call center has worked brilliantly from home, from the work from home setup. In fact, tech, analytics, product, and creative sides have actually been more productive in the work from home setup, especially in a city like Mumbai. We are largely based in Mumbai, where the commute time on average for employees was 2 hours. Now they're all super productive just because they're saving those 2 hours every day. From our credit model perspective, I think what we are right now is so much more different than where we were in February. When we did start resuming businesses towards the end of the moratorium or towards the end of the lockdowns, we actually realized that all the credit models that we had working for us in February are completely junk. They were just not performing the way we were. And we had to do 3 different pilots just to create new models. We actually literally had to do loans where we were uncertain on how they're going to perform, just to retain our models and come back onto an equal footing where we were in February. But surprisingly, after the moratorium has gone down, things have performed a lot better than what we expected. We are all like incredibly happy. I think what Akshay said, November was a month where we are back to parity with February, and I think it looks just as good going forward. I think we've all taken a setback or loss of business to some extent for 6 months. Thankfully, the fundamentals are all the same, and I think we can all continue to move forward at the same pace at which we were doing in February.
Interesting thoughts. Like I totally relate to when you said it's not just about the business model change, but also the style of operating also change. Like people moving to work from home, how do you coordinate with that? That's altogether a different challenge that you have to deal with. So very well put. So that's on the demand side and also on the policy side. Anurag, I quickly wanted to take your thoughts on how it has impacted raising capital or debt from the market. Like especially taking into account that Yes Bank had taken a setback, and then Lakshmi Vilas Bank failing, and then some consolidation happening there. Has that impacted anything on the debt market, or is that still available for us? Anurag, you'll have to unmute yourself. I'm sorry.
Sorry, Amit. So our model is slightly different. Being a credit card company, we work specifically only with banks. So we borrow from banks. And one of the outcome during pandemic was a lot of money actually thrown into CASA accounts in banks. In fact, most of the banks are maintaining huge balances in RBI reverse repo, and also the interest rates have gone down dramatically. So actually, I think after the first 5-6 months, I would say post June July, there is an increasingly money supply available from banking ecosystem to for driving for growth. So I think from March to June was a absolutely uncertain quarter. I think everybody was just trying to figure out how long will this sustain. But post June July, we've seen a sustained recovery, and right now most of the conversation with the bank side are quite favorable. In fact, a lot of banks are coming up and in favor of discussing. Other thing is that consumer demand has moved to digital, even though I might also add that even the physical channel of sourcing, whether DSA, DSTs are back in action, by the way. So while we all were expecting a digital demand to grow multifold, but the physical channels are back. Having said that, there is a clear shift from consumer side to digital channels. So we are also seeing much more openness from banking ecosystem to talk to fintechs, because naturally fintechs are much more agile and fast to deliver digital experience for the customers. So that's the second bit, which has also accelerated the partnership on the debt side. I think equity side, there are a lot of news coming in market. Almost every month we are seeing 3 or 4 big deals being announced. So I guess most of the equity investors have started looking at things. Even in the public market, if you see a lot of FI money coming in. So India is definitely coming up on the radar for everyone. So I would say from here on, things should look quite positive.
Interesting. Karan, any thoughts on this? Like what has been the case for Kissht? Karan, if you can unmute yourself.
Sorry about that. Sorry, I think very similar experiences to what Anurag said. I think March to June was very, very uncertain. Not that we were also trying to raise, but just there was absolutely no discussions happening at any level. June onward, it's come roaring back, both on the equity and debt side. There's a lot of demand. Debt is performing. Debt. There are too many conversations happening. There is just as much interest now as there was before. On the equity side, it's taken some amount of time to warm up, but I think again there was a lot of uncertainty, but it feels like we're back to pre-Feb levels.
Wow. Okay, that's very encouraging sign for the entire industry and ecosystem. So yeah, so that's good to know about the debt side as well. So we touched about debt, demand, and the business model. The fourth pillar that I wanted to speak about is collection. So Akshay, coming to you, like how do you see collections changing because of tech? Like, do you think tech is going to play a marginal role, or it is going to become a main driver of collections, resulting in like physical visits becoming absolutely limited in certain cases? Um,
So I think let's look at two, three elements in collections. The first is lack of technology previously built by financial institutions in collections practices. And that's where fintechs came in and brought in the whole element that we can collect more efficiently and yet do smaller ticket sizes. I think let's look at the early salaries case. We managed to collect 97% of our money ourselves within the 30-day window. And we have deployed not only collection scorecards, but running our own collection CRM, which today powers not only us, but all our third parties who collect till let's say 365. So the entire window comes in where we could run remote operations seamlessly. So I would say the great part is how you use technology better was always the strength of fintechs, and that got really utilized during the COVID crisis. So for example, on a single day we could not get all our people on the collection infrastructure running. It didn't make a difference they were in our roles or they were our third parties, but they could at least call the customer no matter where they operated at. So we could actually support almost 650 people working remotely in the collections practice with our infrastructure. That was part one. Part two, if I look at the inherent customer matrix, I think this is where the scorecard systems really work better. And on a click of a button, our teams could decide which consumers to give more and which consumers to cut back when the crisis was at its peak, right? And the resultant was very interesting. Today, we are left with a portfolio which is much better in quality. We are already seeing first EPD levels of almost 40% lower than pre-COVID numbers, which means that we can now be in a state to really deploy more money on the customer base that we're sitting on. On the other hand, if I look at number of collections opportunities, so today if I look at the customers from 20 cities, we are now forced to operate in 228 cities because the consumer moved back to his hometown. We saw a large flux taking place, specifically people who are less than 30 have gone back to their parents' hometown and are operating from there. Now, how do you build infrastructure and collections capability there? I think that's what's been very interesting on the tech layer, that we have managed to build infrastructure there. Those cities opened up much faster, which meant that if a door knock had to be done, you could lock on the GPS coordinate, not just on the KYC address, and which allows a much throughput journey coming in. So if I look at today, whatever provisioning had to be done for COVID has been done. We are seeing negative provisioning coming in. We are seeing us having a stronger control in collections coming in. And I think here comes the differentiation between traditional companies and the way new age companies will focus to solve every business area. First was the sourcing part, then was the underwriting part. We've done a fair amount of work now in collections to make sure we can collect, right? Because if you collect, let's say 2.5 lakh EMIs a month, you need a solid infrastructure running at the back to manage that entire piece.
Interesting. Yeah, I'm sure the tech and the has to play a big role there. And like it's very encouraging to see that all four pillars are moving towards a healthier signs now, and the lending ecosystem is getting more and more confidence as we move forward. I want to touch upon another topic which is more around the digitization towards things. So Anurag mentioned about it, Karan spoke, and Akshay also touched upon it. So Lizzie, coming to you, like there has been increasing discussion about how digitization is the new face of lending. Like Zestmoney is one of the players who is totally digital, and then on the other side of the spectrum we have banks who have a very strong physical presence. So the question there is like, is it more like a good to have versus must have choice towards digitization, or do you think they can be a middle way of something called as like phygital, which is a term which is coined by this industry itself?
The word phygital.
Yeah.
Oh, can you hear me?
Yeah.
Okay. I know I famously dislike the phygital word. We are 100% digital, and that was a stated objective from day one. We wanted to serve e-commerce companies, and that meant we had to go to 50,000 pin codes eventually, right? So from day one, we had to build for that type of scale, and to build for that type of scale and last mile distribution, phygital was not even an option. I think there is a place for phygital, and I think banks will go that way. But what's the point of building something to improve on the traditional system, but not doing it 10x better, right? To take that old sort of Ford motor car analogy, we're not trying to build a faster horse. We are trying to build a Tesla, right? It's very simple. And so to do that, you've got to be ruthless about a digital only approach. The great thing is during COVID, everybody realized how powerful that could be. And we literally had bank partners, calling us every day saying, how are you still collecting? How are you still servicing? How did you do a completely digital moratorium product? How did you do a completely digital restructuring product, right? All of that stuff we built completely digital solutions for. And it just feels like in the last 6 months, the whole industry has kind of rushed forward by like 3 to 5 years in terms of understanding that you really can digitalize everything. We are absolutely ruthless. I'll just give you one more example, which is that we said we will never do in-store until we can launch in-store with a completely digital self-serve product. And for 4 years, investors, partners, everybody told us that was really naive. You needed agents if you're in a physical store because that's what the customer wants. And we launched in-store during the middle of the pandemic with no physical agents, 100% self-serve, QR, app-based, EMI, first of its kind. And it's booming, it's growing, 800% every month. So I think stick to your principles. Any founders out there that are, wondering, should they be building phygital? If you're a tech company, no, it's digital all the way.
Awesome. Yeah, so Lizzie is very strongly opinionated towards digital for sure, and that's quite a bold move to take that call on the offline stores that you mentioned. Akshay, just jumping on to you, do you agree, resonate with Lizzie's thoughts, or do you have different thought towards digital versus digital?
I think I'm taking on Lizzie's point about really focusing on something which you are really strong at. Fintechs are going to be extremely strong in managing a customer fully digitally. For example, earlier we had to go and service some customers to do KYC compliance, right? In fact, we went and implemented video KYC end-to-end stack for managing customers. It's very important that you invest in technology in such a manner you can service mass volume. Only then you're competing in a large manner. It's not about ticket size. It's not about how large your AUM is. But I think today, if I look at the top 20 fintechs today, cumulatively we've done close to 45 million customers. If I look at the cumulative number of credit cards, it's the same number, right? And this industry would have done this number in the last 2 years itself. And these have all been done fully digital. So as we are growing, we're going to service more and more people. There is a layer for phygital. It's meant for traditional players who have physical infrastructure and how they can do their business with least touch. But we are not building the next mile car, right? We want to go to the moon. We want to fly out of the world, and that's going to only happen if we challenge the clear principles. Why do you need to touch base with a person to validate a document? Why do you need to do many physical elements in the business? And you need to scale faster. I think the biggest success for fintechs have been the reduction in OPEX cost. For example, most fintechs are today targeting a $5 OPEX cost. If I compare a physical company or a bank, they have a $50 OPEX cost, right? It's 10x lower, which means we can do a 10x lower product, right? And if we can reduce this cost by half, we can actually come out with a product which will actually serve the next billion, right? And that is where the efficiencies come into business. And that is why the next versions would be even hyper digital, where the digital infrastructure enables more payments. We are seeing UPI payments coming in. We are seeing many more versions coming in where we can enable infrastructure in a much better manner.
Wow. Okay, that's a very very encouraging thoughts. Anurag, I'll just quickly jump to you, and since that you have spent more than a decade with ICICI Bank, what are your views in banks adopting this digital journey? Where are they in terms of this?
So I think for banks, first of all, it's a very large existing infrastructure, and they are doing, and it's already running, and they are delivering very very large volume. I'm like, so I think it's a journey. Also, sometimes when it's your biggest asset, it takes time for you to shift your focus from there. So I can totally see that most of the banks have started the journey, but they are still, I would say, in a physical manner. For example, when they say digital, they will probably just do an element of KYC digitally, but rest of the thing is still physical. Then, credit processes are being changed. You still have large CPAs running and things like that. So pure digital, like most of us do, would still be less than 4-5% of their overall business. And, it is not a very large significant portion of their business as yet, but almost every bank is on the journey. So, while everybody says around 40-50% of the business happening digital, but if you compare to the way we do businesses, like most of us, it won't be like that. It will be like a one portion of that being done digitally. But I think the OPEX, clearly we are going to see a slightly higher credit cost over next 48 months, or rather, I would not 48, probably 24 months. So, most of the banks would like to, suppress it, the cost of OPEX. So, this is a big cost exercise for, most of the banks. But if I just pick up the point which Akshay and Lizzie said, we are not doing it for cost reduction alone. We believe that our business model requires this to happen. If we have to build things at that scale, for us it is not a cost saving exercise anymore. Our business model depends on that. If we are all geared about how can we gather such a large demand, how can we do it faster? We don't want to hire so many people. We don't want to open branches. And also, to a large extent, I think compared to physical, we will probably offer a 3x or a 4x experience. While in digital, we can offer a 10 or 20x experience. So for us, it's not a cost saving exercise. It's a business model choice. I'm like for example, we don't accept repayments through cash. It's a business model choice because if you got to build an infrastructure, that'll take a lot of cost, and we only accept payment through digital means. Now, so I'm sure there are some segments we are moving out because of these restrictions, but when we solve for that, we'll solve for that, not today. So that's how I would be. But banks are on the journey. It's just that most of the banks depend on technology coming from large partners and stitching it together across different systems. So it's going to take a lot of time.
So we can probably act as enablers for the bank and do something in the joint partnership, definitely.
Absolutely.
Yeah. So that's a very interesting insight. Karan, quickly gathering your thoughts. So when we talk about
Sorry. No, continue.
Quickly gathering your thought, when we talk about digitization, like you have been a strong advocate of like an automation and use of AI and machine learning into the systems to provide a best-in-class experience for the customer. So for you, how big of a game changer is AI in lending or in automation?
I think it's literally the biggest requirement. It's I think the ground zero requirement for you to build anything in lending right now. And it's interesting that when we think of AI in lending, the first thoughts that come to your mind is credit and fraud. But trust me, those are table stakes. Those are chips that you have to sit down with. And the kind of lending that we are all talking about here, the completely digital lending where there's not a human deciding whether this customer looks reasonable to me, whether this document looks original to me. You are talking about a completely digital world where we are literally processing at peak 5 applications per second. Now here, what your AI and your ML models will bring in are literally the difference between you being $1 billion company or you being a defunct company 6 months down the line. And the right implementation of ML and AI is going to be the differentiator between the two outcomes for the companies. Having said that, and I am one of those people who hate the overuse of AI and ML just as buzzwords. But it really, when you look deeper, you realize that AI and ML, although table stakes for credit and fraud, they play a much, much bigger role when you're talking about a 100% digital company. You have to have AI and ML go down even into the app that your agent used to go out in the field. Even that needs to be imbued with usable AI. Your document management system, your telecalling, your call center software has to be imbued with machine learning for it to have a lot more mileage for you. Just the fact that every interaction with the customer is one of the biggest costs that we have to bear. It's not the cost of the loan origination as well itself, but the cost of the customer service is expensive. Using AI both in chat, in voice, in all interactions, and just will incredibly save you a lot of money. And that is the role I think AI and ML plays, not just at one level, but it has to be imbued in all aspects of the company.
Yeah, that should become a norm at some point. And then the point that you made about the credit and fraud as a table stakes is very, very critical for all the businesses to survive. Interesting point. I think the entire panel is very pro digitization. So very, very encouraging to see that. I wanted to also jump upon and talk about the penetration of credit products in India, right? So Akshay, in one of our conversations, you had mentioned that even for like your large part of the customer base is still in the tier one sector and who have never used the credit product ever. So do you want to talk more about it or throw some light there?
Yeah, it's actually interesting. So if I look at our core model is to service extremely young working professionals. At an application level, close to 30% of our consumers have never done any type of credit transaction. If I look at some of the blue and gray collar consumers that we spoke about, apart from a savings account, they have nothing to do with the bank till date. They've not even opened an FD, never actually done any savings, any mutual fund ever in their life, right? On the other hand, if I look at the large portion of our customers, almost 60% of them, they may own a credit card. They may have used their credit card to a large extent, but they have not really harnessed the benefit of how not to end up paying too much interest on it, right? And that's the broad logic, that how do you make sure you build financial awareness in young working India? They should not end up getting over leveraged. They should not end up paying high interest rates. Paying that's something as high as 50-60% per annum is just too high, right? How do you make people more financially savvy so they know how to use credit in a better manner? And I think today the job of the new age companies to manage consumers better, make them use credit to their advantage from an early age, and really so that they can benefit in a large manner. I'll give an example that I think we run in a very good manner. Let's give an example. Bangalore being the largest IT hiring infrastructure in the country, right? There are almost 50,000 companies in Bangalore, and they typically hire 120,000 new tech graduates every year, right? But it's so difficult for these tech graduates to find a house to live because they can't afford paying the house deposit. Now we've been working across all of these companies. So the day he joins, we actually pay for the house deposit. It's a simple problem to solve, but you're actually welcoming credit the day you start working, and it's coming in a simplified manner so you can solve more business problems for him. Eventually, he'll buy his first phone through you. He'll buy his first laptop through you. Eventually, he'll get a credit card offering at half the cost of a credit card through you, and you can retain the consumers in a great manner. So I think that is what's the power of credit. And I think as you hold on to young people, you can do many more things to them. Today, if I look at 4 years back, the consumers that we got, they were 23 years old. Today, they are 27. Interesting, 70% of them still bank with us as their primary credit product, right? Which is great that we are servicing in a great manner to them.
Wow, okay. Wow, that's interesting start. And then I think it's very important for people to understand credit at a very early stage of their life. So the journey that you kind of handhold the customer from the moment he's graduating to probably making him more credit worthy, that's a very, very interesting journey to see. So Anurag, I'll quickly come to you, but before that, I just wanted to share some insight on the polls that we ran. So just on the similar to what Akshay was also mentioning. So we ran a poll about what kind of credit products people are using, our audience is using. Interestingly, about 75% people are using credit card as their popular choice. And Akshay, to your point, about 15% people have never used a credit product ever in their life. Buy now, pay later has like small participation, about 6% from the audience. So, Anurag, coming to you, like I wanted to get your views about the buy now, pay later, which is the number of players coming into the market, and then credit on UPI that's emerging as a strong business model in the recent past, and there's of course there's a credit card as an instrument. So, how do you think about these three as a credit channel for the customer?
Fundamentally speaking, I'll probably take a step back and say, there is a very large demand for credit because we are living in a young country with a lot of aspirations. In fact, I'll probably draw an analogy because I used to answer this question 4 years back when I used to have debit cards and, net banking products, that how do you people choose? So I think the answer is that from where we stand, all of these will grow. And that's what we have seen. We have seen debit cards growing, net banking growing, UPI growing, and as well at the same time, cash is also growing, by the way. So, I guess, this is the, fortunately we live at the cusp of where everything looks just such a massive demand to solve for. So I'll probably make a, first of all, sweeping statement that we're not fighting with each other. There is a very large credit demand. So I guess loans, BNPL, EMIs, credit cards, UPI on rate, credit, everything will grow. And everything will grow because India is a very large country and people have very nuanced choices. I'm like, somebody might just say, I just want to take an EMI product. And somebody will say, okay, I just want to take a credit card because I feel it is more flexible in nature. Or probably I get some rewards. So I think from where we stand, everything will grow. Having said that, I would agree that EMI as a product, people in India have really understood quite well, from an affordability point of view. Even we have seen people holding credit card taking an EMI, either on the credit card or outside credit card. I would argue that most of the people who are running EMI product, they would still see almost 40-50% of their customers holding credit cards. So, and the reason is because it's just so easy and people understand quite well. The second thing is also EMI is a one-time purchase for a very specific product, and people just want to have a clarity around that. There is also a insight around that median credit line for credit card in India is around 65 to 70,000. It's just too small, and the reason is because the active line management has not been done by most of the banks as it is done in other markets. So if you buy, let's say, a 40,000 rupees TV, your line is blocked. And if your credit utilization goes beyond 35-40%, your score starts coming down. And there are also distribution angle to play. I'm like the low cost EMI, the zero cost EMI are very powerful consumer messages. I'm like you walk into a store and you get a 0% EMI. It's a massive consumer message that, okay, fine, this is free for me. So I would say from where we stand, everything will grow. And, I would allude to some of the things which, we keep hearing that, there are elements of credit card people don't like. Good for us because that's what we are solving. Fully digital experience. People have frictions. Want to do, but the point is that, credit card, it's such an old and, product that people understand quite well. And that's why there is a bit of aspiration still attached to it. And also we are seeing that credit card as a product is also proliferating from, let's say, top 10 cities to go beyond that. In fact, if you talk to most of the banks who issue cards in large manner, almost 30 to 40% of the demand is beyond top 10 cities now. Even in the acquiring side, we are seeing, beyond top 10 cities contributing almost 40% or 50% of the volumes of usage. So I think, it's like segments and segments, people will decide what they want to do. But I think few things which, work very well for credit card is like the high frequency use case. I mean, you can use it. Average credit card does roughly around 30 to 40 transactions in a month. So you remember about that. You got a rewards, you got a flexibility of repayment and things like that. Having said that, of course, there are also fear associated with that, which is about higher interest rate for revolve and things like that. And, people are trying to come up with a risk-based APR. But one thing I just want to also highlight as an insight, when people revolve, so nobody revolves thinking that they're going to revolve for more than 6 months. Okay, so it's a very shorter tenure. So it's a very high interest rate, around 35 to 40%. However, the revolve is not beyond 2 months. If it is beyond 2 months, probably going to get defaulted. So, or people will actually convert into EMI. So these are things, but I would make a generic statement that from where I stand, having spent so much time in this, I think all of them will grow because there is a very massive consumer credit demand which we are solving for all across.
True. Yeah, I think in the revolve feature kind of defines like when you are calling it a credit card to a loan product offer, and then the NPAs kind of start looking bad or start looking threatening. Maybe coming to
I just want to add one more point. So a lot of comparison gets done in developed markets, but developed markets people are solving for use cases which are very edge in number. Like student credit, or let's say, I mean, those are big problems in India. But there is a massive mainstream problems in India. So look at what Akshay was saying. This guy is a salaried guy. It's just that people didn't solve it at the right time. Frankly speaking, after 2 years, almost every bank will chase him to take a credit card or a personal loan. It's just that when he started the job, nobody touched him there. So I guess opportunity, the way we are seeing in India, is still mid-market. The product like credit card, which is usually the first product everyone has in other markets, even within bureau, only 14% customers have a product like credit card. A single product will not have beyond 20% penetration in a bureau, which is talking about 200 million plus consumers. So the product penetration is very, very low in middle of the market. Forget about the edge segments and things like that.
I think I have to come in at that point. There's a reason why the penetration is so low. It's a rubbish product, right? Credit cards were invented 70 years ago, before we even had mobile phones. And that piece of plastic is supposed to be authentication technology, right? Look what we've all got now as part of our body. This thing is another organ in our body. Everybody that's walking around with a smartphone today does not need a physical credit card. It's actually madness. We can authenticate ourselves in a million other ways, even using our fingerprint analysis. So we just say, look at the data. In 30 years in India, the credit card.
Let me just say, so as far as engagement underwriting is concerned, absolutely no. I think almost everyone is using that. But let me give you some data around that. So, by the way, as a company, we are agnostic to what people use it, digital or physical. But the guy who actually has a physical card, they tend to have very higher activation rates. The spends per card is much higher.
Anurag, here, I think I think the data trends are slightly different. See, if you look at UPI-based payments, are almost 100 times larger than debit card payments already.
No, but a lot of this UPI data is peer-to-peer.
Anurag, it's taken 30 years to get 30 million users for credit cards in India. Let's just look at that number. UPI in 3 years is at 7x the transaction volume. What does that tell me? I think this consumer base is absolutely one of the most digitally adopting consumers on the planet. People are desperate for new ways of doing things, and UPI has actually proven that we don't need physical infrastructure to build some of the best payment experiences in the world. So we think that India is going to be not just a big pay later market, it's going to be the biggest in the world. We have 550 million people transacting online today who do not have access to a credit card and don't frankly want one. And by the way, it's not just about the form factor, it's also the business model. Young people today want transparency. They don't like to be ripped off. They hate hidden fees. They hate the insecurity of rolling. People want to know exactly what they're going to pay for what they buy. And buy now, pay later and all forms of contextual credit give the power to the customer to understand what they're paying. The other lovely thing about the model in India is we can charge the manufacturer. And if you look at the stakeholders in the consumer value chain, the manufacturer is most incentivized to drive transactions. So why shouldn't they pay the cost of credit? Why should we charge the consumer? So it's a fantastic business model for India. People are so savvy here. They're not going to pay hidden fees. And we want to see literally 300 million people adopting a credit product that works for them, not for a population 70 years ago.
So I completely agree, Lizzie. So, for example, we're using the credit card or a card rails, but there's no card. It's a digital asset on the app. It works seamlessly with manufacturers to build subvention. There is no concept of not interest-free period. It just makes sure that the entire transaction is interest-free, right? And that's the good part. And you can see how much you want to pay, and you avoided all the intermediary costs by doing that. So I think today that's the, and I think the challenge will come from there. Can we build the next product lines which will be as large as UPI? Right? I think that's the big part that we all want to play. We don't want to challenge one existing product. We want to challenge the infrastructure, how it can be done better.
No, absolutely. That's what I was saying, that even despite the growth of UPI, which is good. I'm like, it solves so much of problems in India for not only for consumers, but even for businesses. But still 82% of transactions are physical in nature. So we have a long way to go, all products to solve for. I think we need probably 2 more UPI type products, probably something in credit, something in reckoning, something else to solve all of that. So definitely, I'm completely aligned on that.
Interesting thoughts from the panel. So just actually on double clicking on your point, where you mentioned about how the penetration can be increased with the buy now pay later model. Like if you look at the developed economies, and Anurag made that point, they are like, and then just taking example of Afterpay for audience, like Afterpay had a market cap of $30 billion in month of November this year, and that's an insane amount of valuation for a buy now pay later company, right? So that definitely shows us that there's some market out there, right? How can we reach that stage of growth? Like, what is the next set of growth that we can achieve to
I think you have to understand why Afterpay is valued to such level and why does it make a difference in that market, let's say the Australia market. The cost of credit is 2.5% in that market, right? You can borrow for $100,000 for 1 year for 2.5%. That's why no one wants to do that type of lending. It doesn't make that much money. On the other hand, if you do a 15-day buy now pay later, you get a 1.5%, which means annually you earn 8% on it. So look at the math difference. You earn 6 times more money if you decide to do a buy now pay later rather than a normal unsecured loan to a consumer. So that's why the Afterpay model really works in the Western market, right? But on the
I think we see it as a bit more fundamental than that, actually.
Yeah, you get a payment cost nil, but the idea is different. Credit fuels customer acceptance. Credit also builds affordability. India is an evolving market with affordability has to be the largest reason why people will shift to a product. We've seen these really fly off and everyone today carries a smartphone. It's because it came at a low cost EMI. People could afford buying their first phones, right? We will see that across with every single product line where people would like to buy a product which they can afford. And as they get the affordability picture, you can add many millions or more people. Right. The question is really the 55 million people which 550 million people that can be serviced, which traditional institutions have not been able to. Can we build products for them? Can we build in a digitized version which is easier to service and yet build a business model which makes financial sense?
Got it. Lizzie, you were making the point. We are running very short.
No, just saying. Just quickly, just to finish off, we don't really look at, Afterpay or Affirm or Klarna. These are all versions of the same concept, which is contextual credit. Credit should be delivered alongside the good or service that it's financing. And if you take that to its natural extension in a market like India, we could literally transform the economy. Imagine if farmers could buy their seeds, their equipment through the same way that we would go and get an EMI for a smartphone. We can genuinely empower last mile credit distribution, leveraging existing supply chains of manufacturing and services. So this is not just a sort of cute, stock market story coming from Australia. This is fundamentally a change in the way financial services will be delivered, and India will be the biggest adopter in the world. We have no doubt.
Awesome. That's very great insight. Great. So I think we are running short of time. So on a closing note, just wanted to get a view from panel in a couple of lines on the $1 million question on lending, right? Right before COVID, everyone from fintech to e-commerce to food tech, they were looking at lending as either a new offering in their arsenal or like strengthening their monetization potential. And Kunal had almost equated, right? Like lending is not a product, it's a feature. So how does this panel feel about that? Maybe Karan, we can start with you and then go around the panel, take a couple of pointers here.
I think we've actually worked with a lot of companies, especially Flipkart and MakeMyTrip, which were literally along those lines of thinking, right? They've been thinking on whether lending is a plus or it's going to become a core of them. I think even before the pandemic, everyone had come to the realization that for a lot of verticals in India, fintech or lending specifically is going to be the only real way for them to monetize their user base. And that is the sentiment that we feel, and it's getting stronger and stronger. And I think the next couple of years, you'll see that play out as a strategy.
Anurag, quick 2-line thoughts on that, lending.
No, I guess it's a full-fledged business, and the reason why it is featured for someone because somebody else does that for them. So I guess it is going to be it is a very serious. There are lots of pillar to it. I think you spoke about it, and I think the good thing is we are seeing that a very healthy collaboration. So it becomes feature because like 2-3 people come together and build the product, and that's why it gets shared. But at the still same time, it is a quite a heavy duty business. So definitely it requires deep thinking and efforts to build it.
Cool, great. Lizzie, you want to close this out? And then we can go to Akshay.
I would just say that our vision is that lending to the customer feels like a feature, but the lender should always see it as a business. Simple.
Awesome. Akshay, quick closing.
Lending is a very focused business. One month, if you go to sleep, you're not getting the money back, right? So please make sure that if you want to get into lending, it's your core business. To a consumer, I agree with Lizzie. It has to be the easiest feature that he uses. It has to be as simple as getting an Uber. It has to be as simple, it has to be seamless, integrated in his life. He should not even feel he took a lending product. But lending is the toughest business to run. If you do a mistake, you never get your money back. It's gone.
Okay.
You don't lose commission.
Sorry to cut you there. I'm getting a red signal from the backstage. Thanks a lot for your time, panel. I feel from the discussion today that the trade gap in India is huge and almost to the hundreds of billions of dollars, and we have just tapped the tip of the iceberg. We can always work in collaboration to tap this potential and empower the ecosystem more. So thank you so much for your wonderful insight and for having a great time in the FTX and many sessions. Thank you.
Thank you.
Okay.